Multi-project after-tax cash flow analysis. Assume that we are comparing two different projects, project A and project B, and then asset life is 14 years. GDS recovery for A is 7 years, and then for B is 10 years, 20% more, tax rate 30%. We are only talking about the corporate tax rate here, and then combining the federal and state taxes, everything in that 30%. Just to get a quick idea. So when I was solving that, first I did side by side, and I found it's a little bit more looks like complicated. So in the video, I'm going to be using just one at a time, and then I will copy and paste and see how that goes. So for project A, I have copied everything here. I have copied the GDS recovery rate for 7-year project here as well. Now I'm going to do all the calculation for project A, and then copy this sheet for project B, and then everything will be basically automatically calculated once I copy and paste there. So you can simply type here depreciation, or just simply just cut like this. Depre. So I can not. So the total depreciation would be the cost basis. This times the percent we can deduct. I'm going to freeze that because that will be used for all cells below, times the percentage we can deduct each year. So copy down like this. So you get the depreciation now before tax cash flow. Create that first column. That will be equal to, we have invest this, so that would be a negative cash flow. And then each year it's going to generate a revenue of this. So I will freeze that and then copy all the way down. For the last sale, I have some income from the end life market value for selling this equipment or whatever it is. There is some value left at the end, so we're gonna have to add that at its end life. Now next is to calculate the taxable income. Taxable income. So simply here is 0. Nothing happens in year 1. From year 2, in year 0, starting that in year 1. So in year 2, this end of year 1, the taxable income would be whatever the yearly production minus yearly revenue minus the depreciation of the equipment. So simply we can copy all the way down. Let's see, everything is calculated properly. Yes. So now we got the taxable income. The next is to find the tax. Simply you can multiply this taxable income times the tax rate. We're going to use this again and again, so we'll freeze that and then copy down. I would like to double check that everything was copied right. Looks like it is. So that's the tax. Now we can calculate the after tax cash flow. That would be equal to the before tax cash flow minus the tax. It is the after tax cash flow. Now we can calculate the present value for each of these cash flow. So present value after tax cash flow. So we can use that function called PB. We have used this many times. Now the minimum attractive rate is 20%. I will freeze that because that's going to be used for all 14 years. So each of these cash flow will be treated as a future cash flow, that is we are bringing to the present, and this is the yearly compounding for that. There is no payment, 0. I will use a negative sign for this future cash flow to keep the same sign, and then basically copy that down all the way. Let me double check everything was right there. So now we can calculate this present value, present what, that would be the total of this column. We can also calculate the IRR, sum of, sorry, we're going to use the IRR function. And again, you'll be using that after tax cash flow, this column, not this column. One of the most common mistake I found in the exam. It's not 0, it's because it is not formatted right. So that's 31.53% IRR. We can also calculate the capital recovery. Like this. I don't know how to spell recovery. B-E-R-Y. Recovery. Probably it's right. So we can use simply that payment function, PMT, rate is 20%. Then 14 years, we're going to distribute that present value over 14 years and see how much we're going to get equivalent per year for that total present cash flow, which is about $100,000. And then if we are interested to calculate the future worth as well, we can do that. Simply type that FV function and then same rate. For 14 years, that present value is going to be, do not use both payment and the present value. Just use one of them. Also, again, I would like to use a negative sign so that we can keep the same sign. So that would be the future value of that project. So we have calculated everything for project A. Now we can basically copy this to project, make a new copy to the end, move, create a copy, and we can do it for the project B and basically change this number. So here is this project B numbers. We can simply copy from here. Project B, simply copy like, I don't know what happened. Here we go. So we can copy here. We also need to change this, the GDS recovery, which is 10 years. So from table, you can get those 10 years recovery. I'm going to copy it from here. Let me copy right there. That's project B. Let's see. So this is the calculation for project B. As you can see, the IRR for project B is about 19%, where project A has a IRR of 31%. I did this calculation side by side in this video, on this page before this video, and I think that would be a little bit more brain fatiguing. However, this number is not the same. Let me see why. Because there was a different number there. So let me change that to the number we have. Let me copy it from the PowerPoint, as I changed some numbers and then forget to change there. So here I'm gonna copy like this. Now it looks correct. So multi-project 23.69, 23.69. Yep. So I think it is easier to just work on each project, create a separate sheet, make sure you correctly use that GDS recovery period. If it's different, in this case 10 years for B and the 7 years for A, and then make sure you change this number accordingly as well. To kind of summarize, I think you can just use two separate sheet, or if you have 3-4 project, use 4 separate sheet, and then you can see the numbers. So for in this case, to make the decision, project B doesn't make sense at 20% mark because you are getting less. However, project A makes more sense at 20%. So you will be making more than 20% after tax. If you are interested to quickly see before tax, let me go just for this project B before tax cash flow, IRR. You will see it's definitely more than 20%. We're selecting this column. What did I do? Should be IRR. So it is over 24%. So makes sense before tax, but does not make sense after tax.